Do you think rising interest rates in 2022 are going to cause a decrease in home prices? Well, let's check it out. Hi, I'm Nick with the Iannitti Group. Just want to come at you real quick with a housing update for April. And of course, just hop right in here. Okay, so impact of rising mortgage rates. I've been hearing this a lot of my conversations with my clients. First off, let's just take a look at the rates real quick, right? This is from the end of March. From Freddie Mac, basically, we're at 4.67. I know now we're kind of closer to 5, but let's just call it about a point and a half increase, okay? What I want you to realize is mortgage rates are likely, this is according to Freddie Mac, again, mortgage rates are likely to continue to move higher throughout the balance of 2022, although the pace of rate increases is likely to moderate. In other words, it's going to slow down. Much of the increase in the rates in early 2022 is in anticipation of what will happen later in the year, okay? So what we're looking at, though, I want to give you a historical kind of, some data points here to reference this on, okay? Let's look at what happens previously when we've had mortgage rates rise more than 1% in a single year. This is home prices, right? You can see right here, home prices, historically, when you raise interest rates by over 1%, they typically go up, right? Because people rush in to buy a home quickly before the rate goes any higher, okay? When we look at actual sales, though, it's a little bit of a mixed bag here, right? 11% down in 94, and I'll explain that here in a second, but mostly about 2%, roughly plus or minus. This 14% was right before the housing crash, so that's a little bit of an anomaly, okay? However, when you look at this 93 to 94, you're talking about almost a 2.4% increase, which resulted in a rate of 9%. Okay, so remember, even if we're at 5%, look at these rates here. Even 5% is still historically low. However, no one is saying that we're going to see over a 2% rate increase this year, and no one's going to say that we're even close to a 9% rate, okay? So when I take that out, basically, here's what you're looking at. Again, this 14% was due to the crash, but really historically, yeah, okay, maybe about 2% plus or minus, so not that big of a deal with rising rates. However, let's look at inventory, okay? I don't have inventory data for 96, 2000, but when we look at these 5, 4.5, 4.8, basically 4.8 months worth of inventory with this slowdown in sales, this is nothing like what we're seeing right now. We're seeing 0.5 months worth of inventory, a month of inventory in some places, drastically different market than what we saw here, okay? While this is NAR, while higher short-term interest rates will push mortgage rates up, they expect that impact to be mitigated through lower inflation. They do expect the 30-year fixed mortgage rate to continue to rise, although they aren't likely to see big jumps that we've seen in the past few weeks, right? So keep that in mind, okay? This is another good thing to realize from Freddie Mac. It basically says as interest rates increase by 1%, appreciation slows down by about 4%, okay? We're seeing appreciation right now around 19%. So this would still, even with an increase of a full percentage point in mortgage interest, we're talking about slowing down appreciation to 15%, 14%, okay? So with rates rising and expecting to rise through 2023, it makes sense to obtain a purchase or refinance a mortgage if you're in good standing. In other words, it's still a good time to buy, right? They don't think prices are going to come down. And let's talk a little bit about why, right? Back to just, straight up the inventory that we're actually in. This is from Altos Research. We keep watching for it, but there's still absolutely no signs of the market slowing down anywhere in the data. If anything, we're seeing the market continue to heat up, okay? This is what we're looking at. When we talk about buyer demand across the country, realize almost all the way across everywhere in the country, we still have very strong buyer demand across the country, and a stable in a couple of places or whatever, really only weak in one place. However, when we contrast that to our seller traffic, right, we've got very weak or weak seller traffic almost nationwide. That's not good. So one good thing of good news, though, we did see active listings increase for the first time in 6 months. That's good news. But when we look at that year over year, it's still not where it needs to be, okay? But we're seeing this. I thought this was interesting from Fortune. Now, more industry insiders are throwing out their previous forecasts and replacing them with a more bullish short-term outlook. All right, some experts are basically saying 2022 spring housing market might go down as one of the most competitive on record. We're absolutely seeing that with buyer demand. By the way, I thought this was an interesting metric. When we're looking at pending home sales, historically, about 100 pending homes is a healthy level. Right now we're at about 104.9. So in good shape on there. Okay. But again, back to the buyer demand. Look at the showings. This is data from showing time, right? 271 showings here in 2022. Okay. We're basically already outpacing what we did throughout the pandemic, which is surprising. Year over year price increase again here in January. We're looking at 19%. Okay. Remember, I was calling, if you look at all through the second half of last year, a lot of the experts, myself, everyone, we thought we were going to see the market start to cool off from this 18%, 15%. We thought that wasn't sustainable. We thought things were going to drop down about 5, 6, 8%. It is still yet to happen, even with interest rates rising. Okay. And this is, from DGI. Last fall, we observed that home prices, although continuing to rise quite sharply, had begun to decelerate. Even that moderate deceleration was on pause in January. The 19.2% year-over-year change for January was the fourth largest reading in 35 years of history. Okay, that can't be overstated, right? And we're going to come back into, again, looking at just months of supply. I thought this was interesting, though. For the first time here in March, new listings finally got higher than active listings. That's good news. That means things are being taken off the market quicker. But again, when you look at my market snapshots, I'll do one for San Diego and for Sarasota. You're going to see our active listings, our new listings, our pending listings, and our sales, the number of sales and the volume are all down. It's basically due to our low inventory. It's not due to lack of buyer demand, of lack of financing. And this is why, right? We've had 14 straight years below the 50-year average in the number of homes we are building. This is a problem. We're going to feel this problem for years to come. 3 to 5 years at least, may even take longer. I don't care how high the rates get. Okay, we just simply have not built to keep up with our population growth over the past 14 years. That's not something we're going to be able to turn around overnight. Okay. I thought this was interesting here, this home ownership as a hedge against inflation. Everybody knows that home ownership is typically a good hedge against inflation because you have a fixed good, you have a hard, durable good, and the price is fixed with your mortgage, right? So 18% here over 6%, 6.8% inflation. I want you to realize, though, this number right here, this 6.8%, all the numbers you're seeing on inflation right now, I just want you to realize that if people ever compare them to the 70s, 80s, back in the Reagan and Carter years and stuff, when we had 15, 16%. Well, it's nothing like that. That's BS. We actually changed the way we calculate inflation in the 1980s. If we use the old math, we would see inflation today well above 16%. It would be the highest inflation we've ever experienced as a country. Just kind of a little side note there. Okay. But again, we do expect prices to continue to rise, maybe not as quickly. We've been saying that for a couple of years now, but these are the latest projections basically on a $360,000 home purchase in January 2022. Over the next 5 years, you're expected to make about $96,000. So if you're not in the housing market today, you really do need to be. Okay. Again, back to home price forecasts. Basically Zelman's got it down to 3%, CoreLogic all the way up to 9.6%, with an average of all the forecasts at 6.7%. Okay. So what does that mean? That basically means, an answer to my original question, are increasing mortgage rates in 2022 going to decrease home prices? The answer is no, it's not going to happen. Basically, our inventory is going to power through these rates. So if you have questions about anything that I spoke about here, you have questions about what's going on in your neighborhood, what your home is worth, just reach out to me. I'm always happy to have that conversation with you. Remember, look out for my market snapshots, Sarasota and San Diego, where I'll go a little bit more in depth into the actual housing numbers for those local markets. And that's about it. Thanks so much for tuning in. Remember, who you choose to negotiate for you absolutely matters.